the market goes up and down. If you're investing with a 1 or 2 year time horizon, you shouldn't be in individual stocks, you shouldn't be in equity mutual funds.
Before you start to invest, ask yourself one question.
That's the kind of money you're going to do well with. If you're worried about it, don't invest it.
You can't learn years of stock picking experience in one night, but you have better stock picking skills than you realize. And you have advantages that no one on Wall Street has. You may be wondering why stocks are so important for a long-term investment program. The short answer, over time, stocks produce better returns than other investments. The past 60 years, stocks have returned about 10% a year. Bonds have averaged 6% a year. Treasury bills or bank CDs around 3%. That doesn't seem like a big difference, does it? But the power of compounding makes an enormous difference over time. Suppose you invest $50 a month and earn 6%. After 30 years, you have over $50,000.
When your investment is taxed, the government reduces your return every year. If you know you won't need the money until retirement, you should place as much of your investments as possible into tax-deferred accounts, like IRAs, KIOs, 401k, or 403b plans. Because you don't pay taxes on the money until it is withdrawn from the accounts, the power of compounding achieves the maximum effect, providing you the best return possible.
The more time you have to let your earnings compound, the better results you'll get. A 20-year-old who invests $200 a month and earns 10% on his money all along will have $1.1 million by the time he was 60. A 35-year-old would have to invest $800 a month to have the same $1.1 million at age 60. You're going to have a tough time getting that 10% return without at least some stocks in your portfolio. Before you start to invest, ask yourself one question. When will I need to use this money? Term investment. If you need to use the money anytime soon, you should not invest in stocks.
This is money you're willing to put in the market and leave it there for 5, 10, 20, 30 years. That's the kind of money you're going to do well with. If you're worried about it, don't invest it. The market goes up and down. If you're investing with a 1 or 2 year time horizon, you shouldn't be in individual stocks, you shouldn't be in equity mutual funds.
If you want to double your money quickly and safely, fold it in half and put it in your wallet. Any other way, you're simply gambling. A good stock can take 2, 3, even 5 years before it really pays off. It's not 2 or 3 weeks, it's not 2 or 3 months. My best stocks have been in my 5th, 6th, 7th year. Give your investments time to grow.
When is the right time to sell a stock? Selling stocks is a matter of comparing stories. If story A is better than story B, then sell B and buy more A. If you own 8 companies, you're playing 8 simultaneous games of poker. So only stay in the games that you have the best chance of success. But remember that stories rarely change overnight. It may take years for a good one to be recognized by the market. Give your good stories the time to grow. Investing is a personal thing. You have to do it by yourself. You don't do it with a committee. You have to be able to have the emotional strength to stand the volatility of the market in general and stocks in general. The key organ here is not the brain, it's the stomach. You have the stomach for this. You have the patience for it. You should be able to look in the mirror and say to myself, what am I going to do if the market goes down? The amateur investor probably can follow between 5 and 8 companies. They could lecture in these 5 or 8 companies. They know them very well. There's 10 to 15,000 public companies in the United States. There's lots more overseas. So you don't have to be experts on lots of companies. You just have to know a few very well. It's a lot of fun. It only takes a few hours a month. It's not a full-time job. You don't have to worry about somebody inventing a new computer chip. The story doesn't change that much. McDonald's earnings have gone up, I think, more than 80-fold over the last 30 years. The stock's gone up 100-fold. What made McDonald's earnings continue to grow? If they had just stuck with a cheap cheeseburger and a cheap hamburger at lunch, they probably would have run into earnings problems 10, 15 years ago. But they expanded their menu, they kept their costs low, they added breakfast, they went overseas. Every day they add 2 or 3 more restaurants. People thought there was no room for more McDonald's 5, 10, 15 years ago. They were wrong. If they had done the research, they would have said, well, there's a couple hundred countries out there. There's lots of places to grow.
Actual bad economic news, rising interest rates, wars, elections, any of these can push the market down. If you're one of those people that pore over graphs, economic statistics, or astrology charts, trying to figure out what the stock market is going to do next, you are wasting your time. No one can predict the market.
You have to understand the market goes down. There's been 95 years this century. We've had 50 declines of over 10%. Of those 50 declines, 15 have been 25% or more. So about once every 2 years, the market falls 10%. About once every 6 years, it falls 25%. These are big drops. You have to understand that. That's the nature of the market. If the company does terrific over a long period of time, the stock will do terrific. If the company does lousy, the stock's going to do lousy. That's all you're betting on. This is a company that's had 35 years of double-digit earnings growth every single quarter. We've had changes in the Supreme Court. We've had the stock market go up and down. We've had changes in presidents. We've had recessions. We've had wars. All of those things had no effect on automatic data processing. So every time the market went down, it gave you a chance to buy it. You're saying, I believe strongly this company's going to do well. If you start to see symptoms that's not going to happen, the stock's going to very rapidly respond to that. If the company runs out of steam, the stock's going to run out of steam.
If you start by looking at the entire universe of stocks, more than 3,000 stocks on the New York Stock Exchange alone, and over 13,000 public companies in total, you'll blow a gasket. So I break stocks into categories, partly to make the job of researching more manageable.
Putting stocks into categories is the first step in developing the story. At least you'll know what kind of story it's supposed to be. The category tells you what questions you should be asking about a company. You simply can't expect all stocks to behave the same. Basing a strategy on general maxims, like sell when you double your money, or sell when the price falls 10%, is absolute folly. No formula will apply to all stocks. Different stocks behave differently, so they require different approaches, different expectations, and different kinds of stories. Suppose you've made a 50% gain on two companies. One is a fast grower with a long way to go. The other is a big, lumbering, slow growth company that has already saturated 95% of its market, and that market itself is growing slowly. The 50% return is fantastic for the slow grower. The chances are it's time to sell it. The same 50% return would be just the tip of the iceberg for the fast grower. There are basically 5 categories. 1 would be fast growers, 2 would be slow growers, 3 would be cyclicals, 4 would be asset plays, and the 5th one would be turnarounds. How does a company plan to increase earnings? Sales growth is the single most important factor in growing earnings long term. So you must ask yourself how the company is going to make sales rise. The company can expand its customer base. Selling its existing products to new customers brings in new revenue. When evaluating this strategy, consider how far the company is from saturating the market for its products. If a company is already selling to 98% of its potential customers, there aren't a lot left to reach. The company can introduce new products into its existing customer base. This is the most difficult, but potentially the most rewarding strategy. If the product catches on, it can breathe new life into the company. Advantages like brand names and a good reputation come in very useful here. A company can also raise prices to increase revenues. That way, even if unit sales stay constant, revenues will still grow. Of course, the danger of raising prices is that the higher prices will drive customers to competitors, or encourage new competitors to enter the market. The details of a company's plan will vary by industry and by individual company. Just make sure you understand that plan and include it in your story. Once you've built the story for your company, you have a powerful tool for judging the stock. But like any powerful instrument, you must use it wisely and carefully, or you'll get burned. Use your story to pick the right time to buy a stock. I promise you that the right time to buy a stock does not occur often. When I'm following a stock, buying opportunities present themselves once or twice a year, if I'm lucky. I look for times when the potential upside is high and the potential downside is reduced. Understanding that balance is a key to successful stock investing.
You have to understand stock picking is a risk-reward trade-off. You have to know how much you're going to lose if you're wrong and how much you're going to make if you're right. The skill is to minimize your risk and maximize your reward.
Everyone can do well in the stock market. You have the skills, you have the intelligence. It doesn't require any education. All you have to have is patience, do a little research. You've got it. Don't worry about it. Don't panic.